Now, if I had to start all over again in my investing journey, this is the one ETF I would hold forever. Now, I've been down nearly every passive income stream you could possibly think of. Picture this: affiliate marketing, rental properties, buying one rental property per year for the first 10 years, selling options, delivering courses, and the list goes on and on. But I have to say, from all of my experience, this form of investing, index investing, is by far the most passive way to getting your first million. In today's video, I want to share the one ETF that I would hold forever to get to your first million. Now, there are so many ways to invest in ETFs, into indexes, and it could get super confusing. So I'll share the most popular ways, and some of the results were even surprising to me. And there are 5 big fat myths about index investing, and these potential mistakes could be killing your wealth building potential. Now, just in case you don't know me, my name is Tracy. I'm a former engineer that now manages a multi-million-dollar investment portfolio in my spare time. Now, I'm a stock and real estate investing nerd that's on a mission to help you become a confident investor and shorten your learning curve by decades. I'm not a financial advisor, but I'm someone who talks the talk and walks the walk. Now, one of my most favorite ways of investing, especially my kids' accounts, is buying 500 of the biggest companies in the United States. And there's an ETF for that. It's called the S&P 500. Even Warren Buffett, one of the most successful investors in the world, has been super vocal about this form of investing, particularly the S&P 500 index fund. One of his most favorite quotes is, "A low-cost index fund is the most sensible equity investment for the majority of investors." So if you're looking to invest in 500 of the biggest companies in all of the United States, there are 3 popular ETFs. There's VOO, VFE, and VSP. VOO is traded in New York Stock Exchange and is in American currency. VFE is traded in the Toronto Stock Exchange and is traded in Canadian currency. But if the Canadian dollar changes a lot compared to the US dollar, well, this ETF can also change as well. Then there's VSP, which is the Canadian version of VOO, but has a protective strategy. That means if the currency changes a lot, Canadian dollar versus the US dollar, you're less exposed to the currency ups and downs. Now, what's even more surprising is out of these 3 popular ways of investing is that they've all given different returns. And I was pleasantly surprised to learn that the Canadian hedge, VSP, is the worst performer out of the 3. Now, if you're scratching your head and wondering out of the 3, which one to choose, that's a great question. So let's look at past performance. Surprisingly enough, VSP is the worst performer out of the 3, even though it has a protective strategy against the currency ups and downs. And VFB, the Canadian version of VOO, which literally just holds VOO, but in Canadian currency, is the best performer out of the 3. Now, before you jump in and go all in VFB, I want to warn you, past performance doesn't mean future performance. And in the past, the Canadian dollar was actually more on par with the US dollar. So maybe that's why VFB performs so well. Also, unfortunately for us Canadians, when we collect foreign dividends, like from the United States, which VFB pays a dividend, you get a tax of 15% withholding tax on all your dividends. It's just simply how the ETF is set up. Well, VOO has the lowest management out of the 3, and the dividend yield for VFB is slightly lower than VOO's dividend yield. Now, if you're super confused by all this, the most optimal way is invest in VOO in your RSP so that you don't have to pay the 15% withholding tax, because we are very fortunate that the RSP is the only account that avoids this, and then VSP or VFB in all your other accounts. Now, I just want to do a brief pause and share this amazing platform that I've been using. If you've been juggling multiple brokerage accounts, like Wealthsimple, Questrade, your bank, it's probably driving you nuts. It definitely has for me. But what if you could see it in one simple platform? Well, meet Passive, a simple tool letting you see and manage all your accounts, your TFSA, your RRSP, your RESP, all in one spot. You can invest and rebalance your portfolio with a click of a button and seamlessly manage between multiple accounts. And a bonus, if you are a Questrade user, you could put your investing on autopilot. Now, if you're worried about privacy issues, Passive never has access to your account info. You can feel safe about linking your accounts. Hit the link in the description below or in my pinned comment. Sign up to Passive for free and you're a Questrade user. Make sure to upgrade to get your premium features because it's free. Now, before I share how to get your first million investing in this very popular ETF, I want to share the 5 biggest myths about index investing. And these financial mistakes could be killing your wealth plan. Number 1, just because the S&P 500 over the past decades and decades have returned on average between 8 to 10%, it hasn't been a straight line up. You look at it, there's been bear markets, which mean the markets have gone down and the stock prices have dropped 30%, 25%, 40%. So there are times when the stock market isn't doing well and you have to hold on for dear life and think long term. Number 2, no risk. Some people believe that because you invest in 500 of the biggest companies in the United States that you're well diversified and that there's no risk. Well, investing always involves risk. It's just a calculated risk. If you look back at 2008 during the financial crisis when the world seemed like it was ending, that meant the S&P 500 had a significant downturn. Number 3, fully diversified. Now, a lot of people believe that because you invest in 500 biggest companies in the United States, that you are probably equally weighted between all sectors, but that's far from the truth. The S&P 500 makes up 500 of the largest, most valuable companies. This means that larger companies have a bigger impact on its performance. Over the past few years, tech companies have taken a larger and larger market weighting in the S&P 500. If you look at the top 10 holdings, so many of them are tech companies. And you could feel you're over-concentrated in the tech sector, which skews diversification. Now, at this point in the video, you might be taking a lot of notes, but don't worry, I got you. I have an in-depth masterclass on how to get started investing in Canada, sharing the most popular ways of investing. Just click on the link below in my pinned comment. Number 4, it's only US exposure. In reality, the S&P 500 actually does represent a lot of US companies, but these US companies are multinational. Just look at Microsoft's got arms around the world. So in reality, you are actually invested around the world, which exposes you to international markets, which has its pros and cons. Last myth is that all S&P 500 index funds are the same and should give you the same returns, which is absolutely not true. We looked at VSP. It has a protective strategy where it should protect you from the currency fluctuations between the Canadian dollar and US dollar. But it has a higher management fee. And if you look at the returns since inception, it actually is the worst performer compared to VFV. Even though VFV is trading Canadian currency, it also has a higher management fee than VOO, which is a US currency. So when you're looking at different ways to invest in the index, like the popular S&P 500, just be aware that they have different management fees. They also have different dividend payouts. All of this can impact your net return. Now, as promised, I want to share 2 ways of how to get your first million through index investing. S&P 500 has returned 8 to 10% on average for decades. Now, I'm saying 8 to 10 because there's some years that have exceeded well over 10. There's some years that, well, obviously haven't done so well. So let's take a very conservative approach. Now, very practical investing approach is to take 10% of your salary and invest. So if you made $60,000 a year and you took $6,000 and plunked it into the S&P 500 and just held it every single year, taking 10% of your salary, assuming you never increase your salary and do it for 35 years, you're going to be well on your way becoming a millionaire. Just because the S&P 500 has on average returned 8 to 10% for decades. Now, sure, there are some years where you get double-digit returns, and there are some years, well, it just ain't doing so well. But on average, you can reliably expect 8 to 10% at least for decades. So $6,000 may sound like a lot, but if you break it up per day, it's only $15 a day. I'm sure you could save on a Starbucks latte, save up on an Uber trip, take the bus more frequently, not eat out at lunch every single day and find a way to save $15 a day. Now, here's the second approach, and this one takes a lot less money. In fact, you don't have to invest $6,000 per year, but you just need a lot more time. And this is probably going to be more relevant if you have a family and you want to transfer some wealth. So the second way is simply invest one time $6,750 into the S&P ETF like VOO and just not touch it. Imagine you have a newborn baby and you want to transfer some wealth and make your baby a millionaire. So you take your TFSA and plunk in $6,750 and invest in an index fund like VFB. And you could just conservatively assume that VFB over the long run will return at least 8% a year. And if you just held it in your TFSA and just invested once, $6,750, and held it for 65 years, that means when your kid turns 18, you could transfer your TFSA, that $6,750, the original principal payment, which obviously would have grown by that time, and plunked it into your kid's TFSA and just said, do not touch it until you're 65 years old. Well, guess what? You made your kid a millionaire, which took a lot less money, but you needed time. Now, at this point, you might be wondering, what are other ways to get to your first million without putting everything in the stock market? So make sure to hit the subscribe button and that bell notification button so you get the next video where I share a series on how to get started to your first million if I had to start from scratch.